fourth session under tax audit course, taxation course that we have undertaken, study course on tax audit. And tomorrow we will be having a physical session on practical studies with a panel discussion. I welcome Rajesh Patil sir on behalf of Nasik branch for accepting our invitation for conducting today's session. Today we'll be having session on other audits under income tax under 80 JJAA, MAT and AMT. I request our branch chairperson Sohil Shah to introduce today's speaker.
Thank you, Sanjeevan. So it's my privilege to introduce our today's speaker. Very learned speaker for today's session. We have Rajesh Patil sir. Rajesh Patil sir is a fellow member of ICI and has more than 25 years of experience, mainly in life science and healthcare and manufacturing sectors. Rajesh sir advises clients on various tax issues, including cross-border tax planning, contracts with foreign enterprises, and on taxation of foreign enterprise in India. He has also represented clients in assessment and appeal proceedings before various tax authorities, including tax tribunal. He has excellent relationship with an Indian tax authorities. He is chartered accountant and commerce graduate from Mumbai University. Sir has made presentation on different topic at various seminars organized by professional and industrial organization in India. So with this brief introduction, I request sir to take the charge and take ahead with the session. Over to you, sir.
Thank you very much. Am I audible?
Yeah.
Okay, very good. Thanks. Thank you very much for this nice introduction. It's my pleasure again to be, to present my thoughts before you all. Again, a couple of years back, I had spoken on, for foreign remittances, payment under Section 1, and that was before pandemic, and that was in-person meeting. So, last couple of years, as you know, this COVID had made, many physical things like virtual, and this COVID had taught us so many things. And this virtual learning is, all of you will agree, this virtual learning is one of that. So, thank you very much for giving me this opportunity again. So today's the topic for the discussion is, as has been mentioned, is audit. Audit related certain sections like JJAA, then MAT and AMT. So as we progress, I will just share my screen and share my presentation, and we can discuss that. So as we progress, if there are any questions, we'll also take them, because these are all the thoughts which I have shared based on what knowledge or the material that we have based on the Income Tax Act, prevalent Income Tax Act, and the law that is applicable today. Because when we audit, we'll have to see what is the law today, and that will be applicable for issuing the reports under these various sections, JJAA, MAT, and AMT. Okay, so let me share my screen. I hope all of you can see my screen.
Yes, sir.
Very good, thanks. So I'll just put it in the presentation mode. So the topic for discussion, as we have mentioned, is deduction under Section 80 JJAA, MAT, and AMT. So first we'll start with 80 JJAA. So all of us know that this section, is basically the deduction or under this section for incentive for the employment generation, in a way that the organizations which are eligible organization, I would say, because as we proceed, we will know who are the what are the which are the organizations which are eligible to claim this deduction. So eligible organizations are like incentive to them over and above deduction which they get under Section 37 of the Act. Okay, so this is an incentive for employment generation and provides deduction, from income from business under the head income from business and profession, and from the business income to an SSE for the employment of new employees of the SSE. So additional employees, what are the additional employees? What are the qualifying employees? And what type of expenditure is eligible, to claim under this section. We will see as we move further. So as we know, when to claim the deduction under this section, the auditor also needs to give the report, and report is provided in form 10DA, which is provided under the Income Tax Act, in the income tax rules. So form DA is the one that auditor needs to certify, and the person who is claiming the deduction need to file upload this form along with the return of income when it claims. Now there are controversies in suppose what happens if the assessee is not able to file along with the return. So does it mean that he has permanently lost, or is there any, there are judicial pronouncement on this front. So as we move, we'll touch base on those as well. Now, as I mentioned, this deduction can be claimed for new additional employees by any person, be it individual, HUF firm, LLP, company, having income from business and is subject to tax audit. So these are the two basic criteria. So when when we are issuing the report, one needs to see whether there is income from business, okay, and whether that assessee is liable for tax audit under section 44 AB of the income tax. As you know, there are various criteria for who are required to get accounts audited under section 44 AB. So this twin condition needs to be satisfied, that there has to be income from business and the assessee should be liable for tax audit under section 44 AB. Mind you, professionals can't claim because not available to person having professional income. So like people like us, are not eligible. It has to be only those type of assessees which are, which has the income from business and not from profession. So professionals can't claim the deduction under this section. Okay, and earlier there were certain restrictions, like who all can claim, like whether trading, etc., non-manufacturing, etc., were not eligible. Only manufacturing was, because there was a reference to workmen, etc., under Industrial Dispute Act and so on and so forth. So all those conditions have done away with. Now, with effect from assessment year 17-18, the deduction can be claimed by any assessee having business income from manufacturing or non-manufacturing, like trading, etc. And only thing is, twin condition needs to be satisfied, that there has to be income from business and that assessee is liable for tax audit. Now, when I say assessee and not unit, there are again controversies and clarification. So as we move further, we will see what complication and controversies, what are the controversies and how we can deal with. And this third bullet on the screen, you can see, there is an amendment in section 44 AB, like, where the 95% of receipts and payments are, are made through banking channels. Then, the limit now stands at 10 crore. So all those, that is eligibility for getting the tax audit done, so one under section 44 AB. So once when you are reviewing or issuing the tax audit report, I mean the report under section 10DA for claiming the deduction, so you also need to ensure that you meet this turnover criteria or this eligibility, and who are required to carry out the tax audit. So those turnover limits, because there are changes, 5 crores, earlier it was 5 crore, first it was 1 crore, then 5 crore, and now the limit is 10 crore. So, that one needs to take care. Now what happens, there is actually the deduction under this section is available for 3 consecutive years, 30%, as we'll see as we move further, what is the quantum of deduction. So it so happens that in the first year, there is a eligibility of the assessee to claim the deduction. Okay, in the next year, it so happens that tax audit is not applicable to him. or there are no additional employees, on which this deduction can be claimed, because the section says that suppose there are 100 employees in year one, you claim deduction for those 100 employees in year one. In year two, there are 130 employees. Then you claim deduction for those additional 30. So in year two, what you get is 30% of that year one, as well as 30% of year two additional employees. That is, in my example which I quoted, is 30. So it so happens, suppose there may be a case or situation that in year two there are no additional employment generated. There is no additional employment. Then what happens? Do you have? I mean, does that particular assessee is not eligible to claim the deduction? That is not the case, because that 30% of the year one, additional 30% still you can claim in the second year. And there may be a situation that in year two, due to certain legislative changes or whatever, that assessee is not eligible to get the accounts audited under section 44AB. Year one, there was eligibility, or assessee has to, I mean, it was assessee was eligible to claim, but year two, because of changes like I said 5 crore, 10 crore, these amendments have there are amendment in the section, and it so happens the second year that assessee is not liable for tax audit. Then does that mean that he is not entitled to claim? No, that because in the year one he was entitled, and year two, just because there was the turnover criteria is not met, okay, or there are no additional employees, but still in 30% of year one expenditure, still he can claim. So that is possible, and practically we have done it. At least I have done it, and it is possible, and it has sailed through the assessment proceedings as well. So what is the quantum of deduction? As I mentioned, 30% of the additional employees cost in the year one when the business is set up, it is the entire cost. Year two, the addition to to year one employee cost. So this additional employees, and the cost that is incurred on these additional employees, and consecutively 3 years. So in the second year, how the 3-year criteria is to be applied. In the second year, whatever are the additional employees, so 30% of that. So for second year, it becomes year one. Then again, 3 consecutive years you can claim for the additional employment. So it goes on in that manner. So 30% deduction is available on the employee cost. Of course, there are certain conditions as well that we need to see as we'll see then what are the additional conditions. There are restrictions in what manner and to what extent you can claim, what are the conditions subject to which this deduction is available. Yes, so suppose it may also happen that the new employees which have joined, in the second year, as in my example 30, have left in subsequent year. So what happens? Whether the 30% of the second year is available in the third year or not is the question. Okay, then it has been practically we have done it. Even if those additional employees have left in the third year or the second year, of the claiming the expenditure on the additional employees, still you can claim the deduction in the subsequent. Because what happens that eligibility you have to see in year one itself, and not in the subsequent year. Those employees have left in the subsequent year, still you can claim 30% of the expenditure incurred in the earlier year in which this additional employee cost has been incurred. Now, this second bullet, this I already discussed, that suppose in the subsequent year the assessee is not eligible or entitled, not required to get the tax audit done, still he can claim the expenditure which he has incurred in the earlier year and 30% of that, which is brought forward from the earlier year of the expenditure, still he can claim in the subsequent years, even if such assessee is not required to get the tax audit done. And this has also sailed through the assessment proceedings, which I had the opportunity to represent, and this has been sailed through, because specific. Why I'm saying there was a specific query that was raised, there is no tax audit this year, and still how can you claim? So where the representation or submissions were made to the assessing officer, and I'm happy to share with you, that there the assessing officer was convinced, yes, what even if there is no tax audit in the subsequent year, still the deduction is available. Now, as I mentioned, there are certain conditions subject to which this deduction is available. The person claiming the deduction under this section, that business should not have been formed by splitting up or reconstruction of an existing business. Okay, so suppose there is a splitting up that has happened, and because of that, this business has come into existence. So and this business is claiming deduction under this section, then such business would not be entitled, because that's a precondition that it should not have been formed by splitting up or reconstruction. Of course, there is an exception provided that it shall not apply in respect of business which is formed as a result of re-establishment, reconstruction, or revival, specified in section 33P. So that's what is the exception that has been provided. Okay, and the second condition is also there, that this business is not of the business which is assessee has acquired by for transfer from any other person, so if he has got that business from any other business, any other person, and then there is income from business and liable to tax audit, those conditions are satisfied. And so if this is the case, then again the assessee will not be entitled. Okay, and then there is another condition, is that there is a requirement that the assessee furnishes the report in form 10DA. I mentioned in the beginning that one of the conditions is that the assessee need to file form number 10DA, which is the auditor's report. Okay, in form 10DA, which is also required to be filed before the specified date. Now there are controversies, like we will see as there are judicial pronouncement which has dealt with filing of the return, etc. Filing of the report along with the return. If by chance it so happens that not able to file, then or forgets, assessee forgets to misses to claim in the return, then what happens? Has he forgone? I mean, he is disentitled and can't claim deduction under this section. There are judicial pronouncement to this effect. As you know, from assessment year 2021, like tax audit, this report is also required to be filed 1 month prior to the due date of filing of return. So if it is November for assessees due date, then by 31st October this report must be ready. So 1 month prior to the due date of filing return. Now, as we see, this is the form 10DA. So this is required to be provided along with the return of income. So you need to certify that you examine the accounts, records, okay, during the year ended so and so, and then you need to certify that the deduction has been claimed by the assessee under this section, and assessment year you need to mention, and the amount also you need to mention what is the eligible amount. Eligible, what is the amount that assessee is entitled to claim, and then it requires to be signed. So the particulars are to be given in the form of annexure, the name of the SSC, address, PAN, then what is the additional employee cost that is incurred, right? Number of employees in the immediately preceding year, then number of employees employed during the year. So this comes as an additional employee, that I was referring to. The number of employees, additional employees, emoluments, what is the cost? Okay, the total amount of emoluments paid or payable, entitled, what is the amount that is entitled? So you may have incurred so much of additional employee cost, but what is the amount that you are eligible to claim? And then 30% of the current year, 30% of the immediately preceding year, and what is the total amount. So entire this computation is required to be given, and this needs to be certified by the auditor, and the report is required to be uploaded on the on the income tax website 1 month prior to the date of filing of return. Now, what is the meaning of the additional employee costs? Because that's also relevant, and explanation to section 1 defines, what do you mean by additional employee cost? Because that is required to be provided, and in the auditor's report, which I just showed to you, that it is very much necessary that the SSC mentions what is the additional employee cost. So in case of what has been provided in the explanation is in case of an existing business, okay, there is no increase in the number of employees from the total number of employees as on the, this will be nil if there is no increase. Like in my example, which I provided, that 100 and 130, 30 is the increase. So 100 depend in the subsequent year, there is no additional employee cost. 100 remains 100 in year 2 as well. So in such a case, there will not be any additional employee cost. So only what we can claim is 30% of the preceding year. So it will be nil in respect expenditure, in respect of eligible expenditure, in respect of the additional employee cost. Similarly, the deduction is also not available in case all these emoluments or the payments are made otherwise than by an account pay check or account pay bank draft. Okay, so and also the by use of any other electronic clearing system, like this NEFT, so on and so forth. So if it is made otherwise than banking channels, like in short, if it is paid by cash, then the SSC will not be entitled for and the auditor also has to be very careful while issuing, when you are doing the audit and issuing Form 10DA to eligible SSC, you need to ensure that this conditions are complied with. And in case of new business, in the first year, emoluments paid or payable to employees employed during that previous year shall be deemed to be the additional. So, when the new business is set up, see, entire employee cost, entire employees employed during that year, that will be the additional employees cost. It need not be, in case like, there is no business in existence in the earlier year, it's the first year. So entire employee cost of that year is the entitlement, is entitled for deduction under this section. Of course, other electronic modes have been prescribed by assessment year 2021. So we also need to see that, when you are issuing this audit report under this section, then it is required that you see how the payments are made, what is the modes of payment, whether it has been routed through banking channels or not. So that's also a mandatory thing to be looked at. Similarly, there are other conditions like the employees who are drawing more than 25,000 per month, are not entitled. So those employees whose salary is more than 25,000, the cost of such employees will not be entitled. So normally what is provided is, there are small businesses where they are burdened with higher taxes. So it's like an incentive to those people. So where the employee cost is less than 25,000 per month, so only those those emoluments or those salary cost is entitled for deduction under this section. This has been provided in explanation 2 to section 8 JJAA. So mind you, I mean, when you are issuing the report, doing audit under and issuing the report under this particular section, you need to see that what is the employee per employee cost, whether it is exceeding 25,000 or not. Secondly, an employee for whom the entire contribution is made by the government, okay, under employees pension scheme, is also not, those organizations are also not entitled for claiming the deduction. Okay, and then there is a threshold that is provided that these employees must be employed for at least 240 days in a year in the previous year. So those who are those employees who are employed less than 240 days will also not be, cost of such employees will also not be entitled for the deduction under this section. Of course, there is a relaxation is provided for the business of manufacturing of apparel and footwear, etc., and or leather products, where the threshold of 240 days has been reduced to 150 days. So basically, to incentivize these small businesses that they incur the employee costs. So it's like incentive for them. Similarly, the employee who does not participate in the recognized provident fund, cost of such employees will also not be entitled for deduction under section. So all these conditions need to be satisfied, apart from the other conditions which we saw, the business of reconstruction, etc., and transfer from any other person, etc. These additional cost, additional conditions also need to be satisfied. Then certain expenditure is also not to be considered for the purpose of what is emoluments or what is the cost. Now, what are those emoluments, or which type of expenditure need not be should not be considered for the purpose of calculating deduction under section 8JJAA. So when you are issuing or issuing or signing report and issuing a report under in form 10DA, you also need to see that is there any contribution paid or payable by employer. So you don't have to consider the employer's contributions, like equivalent whatever contribution employee makes, the equivalent contribution is also made by the employer. So that employer's contribution should not be considered as a emoluments for the purpose of claiming. So that portion you need to exclude. Similarly, any lump sum payment made, such as gratuity, severance pay, leave encashment, at the time of termination of the employment, or at the time of superannuation or voluntary retirement. So all these lump sum payments will also be excluded from the eligibility for claiming the deduction under section under this particular section. Then the issue that really comes, like certain organization may pay leave encashment at the end of every year, whereas some employers may pay, there is accumulation that happens, and the employee generally claim deduction only at the time of retirement or resignation. So in such a case, the organization may have this difficulty. I mean, they will not be entitled because it comes under the disqualification criteria of lump sum payment, at the time of termination of the service. So that particular amount will also not be entitled for deduction. So these are very important points. So when, in case, when you are signing report or issuing a report under this particular section in Form 10 DA, so you need to ensure all these exclusions like, leave encashment, etc., of the lump sum amount or the country employer's contribution is duly taken care of when you report additional emoluments amount in Form 10 DA. Similarly, who cannot claim, like those organizations who are not registered with PF authorities. Similarly, those who are not entitled for tax audit, and the contractual employees. Employees, because those will also expenditure on such employees will also not be entitled because they do not participate in the provident fund scheme. So one of the condition, as you have seen, that the organization require to be registered with the PF authorities for claiming the deduction under this section. So therefore, such employees, expenditure on such employees will also not be entitled for claiming deduction. Now, not subject to audit, we have just discussed, like due to change in the law, it may happen year one that organization was entitled for deduction, but then subsequently due to change in the, can you unmute? I think somebody is, I think his mic is on. So because it is slightly disturbing the others as well. Thank you. So in the subsequent year, it may happen that there is no tax audit. We have seen that in the year one, the SSC was entitled for tax audit, but in year two, it so happened that due to some change in the regulation, etc., threshold, the SSC is not entitled, but still he can claim the 30% additional of the earlier year. Now, another important point to remember: there is one SSC. Okay, he has two different businesses. Okay, business A, business B. Okay, now business A is eligible for deduction under this section, but the other business is not entitled for deduction. So does that SSC loses the deduction at all? So the deduction is called SSC, and it is not the business. Even if one business is not entitled because non-fulfillment of the conditions, but another business of the SSC is entitled because that business satisfies the conditions, still SSC can claim deduction in respect of the undertaking or the business which is entitled for deduction. It's not, SSC per se does not lose the deduction because the deduction is not core business, but it is deduction is core SSC. So if SSC satisfies the condition in respect of a business, then he will be entitled for deduction under this section. Though the other business, non-qualifying business, he will not be entitled, but for the qualifying business, he will be entitled to claim the deduction. Similarly, we have seen this particular, though the people who are claiming opting for presumptive tax 44 AD, right? So presumptive tax, as you know, there are deductions you can't claim. You have to, there's a percentage of the turnover or the profits on which you are offering your return, filing the return on that basis. So if you are opting for this presumptive taxation under 44 AD, then also you can't claim deduction under this, although your business may be entitled for deduction under this section. Your business may be eligible to claim deduction under this section, but because of section, the provisions of section 44 AD, if any SSC is providing I mean, claiming deduction under this particular, offering the income under this section, then, it will not be entitled to claim. You cannot claim deduction because section itself prohibits the claiming deduction for, under this scheme. Similarly, even if there is one employee, even expenditure of that one employee could also be claimed. It's not that there is no threshold that so many number of employees should be there. Only condition is that the business or assessee should comply with the conditions which are provided. Even if there is expenditure on one employee, still deduction can be claimed. As I mentioned, that this deduction is over and above the deduction which otherwise assessee can claim under section 37. So it's additional 30%, like as the salary cost, etc., is when you are computing your income under the head profits and gains, and salary cost is claimed as deduction subject to complying with the other conditions. Then this deduction is over and above the deduction that is available under section 37. Similarly, we have seen that many corporate assessees were claiming that concessional rate of tax 15%, 22%. So those, for them also, this deduction is available. So even if you are claiming deduction under 115 BAA or BAB, still, this ETA JJAA can be claimed, because, there are the conditions provided in those sections. You cannot claim certain deduction, but this deduction under this section is available to such assessees as well. Now, there are certain judicial pronouncement. I said in the beginning that one of the requirement to claim the deduction is that assessee must file the audit report, within the time by the due date. That is now, as it is provided, that 1 month prior to the due date of filing return. Now, it so happens that assessee is not able to file. That is it the case that he loses the deduction permanently? Like he will not be entitled to deduction at all. Then actually, this controversy and this issue got resolved by earlier. There was a Bombay High Court as well under for ATI-J. Like ATI-J also, as you know, the section was there, but now it is not there. It is deleted from the statute book. So there also report the audit report was required to be filed along with the return. But then the Bombay High Court, in that case, it is reported in 209 ITR. In that case, Bombay High Court held that it is direct. It is just a directory. It is not mandatory that you must file. Okay, and that logic is being followed by so many other courts, like in this particular, which I have mentioned in the screen, then the slide, like Jeans Net, it's a Bangalore tribunal. Those section mentions that assessee is required to furnish along with the return, but the tribunal has taken the position that it is directory, it is not mandatory. Then even if during the course of the assessment this report is submitted by the assessee, still deduction must be given to the assessee. Now, it so happens that sometime it may happen that assessee has forgotten to claim, though it is entitled. Subsequently assessee comes to know that this deduction under this section is available, but he has forgotten to claim. Then Delhi High Court has taken a position that where the assessee company had failed to claim the deduction, under section JJAA, as well as in the revised return, it had revised the return. Okay, in the revised return as well, the assessee had forgotten to claim. Then the Delhi High Court has taken the position, even if subsequently, even after filing the revised return, if assessee makes the claim, during the course of the assessment, and or subsequently, it brings to the notice or attention of the assessing officer that the assessee is entitled for claiming the deduction. In that case as well, the assessee must be, the court has taken the view that assessee must be granted deduction under this section. So it's not lost. It's not, for though assessee has forgotten, not filed along with the return, but filed during the course of the assessment, assessee has forgotten, okay, to claim, but still, by way of communication or statement, of course, assessee needs to file the auditor's report, that is mandatory, but still, subsequently as well, assessee can claim the deduction. Now, certain issues came. Now, of course, the all assessees, like, earlier it was restricted to manufacturing. Thereafter, the deduction is extended to all the assessees carrying out retail business or, trading business as well. So the issue came exactly, in this particular case, Bangalore Tribunal, whether this assessee engaged in providing, caller tune, ringtones, etc. Do they fulfill the criteria of manufacturing, trading, eligibility under the section? The tribunal has taken a view that the company who is providing the value-added services such as caller, ringtones, voicemail, missed call alert, etc., is also a type of manufacturing company falling under the ITS category, internet providing services, and still, such company would also be, such assessee would also be entitled for deduction under section, under this particular section. Similarly, software development, whether it amounts to manufacturing or not, whether it can claim the deduction or not. Again, the Bangalore Tribunal has taken the position that even software development companies are also entitled for claiming deduction under this section. Okay, so before going to Matt, do we have any questions? So, we can just briefly deal with them. Anybody has any question, needs any clarification, etc.? They can unmute and just, ask question. I think the provisions are so clear. Probably there are no questions. So with this, can I proceed? Proceed further? I mean, or should we wait for any questions? Yeah, please proceed. Om Prakash ji, you can proceed if you have any questions. I think you'll have to unmute and ask the question.
Yes, sir.
Yeah. Somebody had raised the, I think Mr. Om Prakash had raised the hand. So I thought there is some question. So
Sumani sir, do you have any questions, sir? Sir, we will take question at the end if sir have any questions.
Okay, sure. Not a problem. We'll give time for question. So next topic for discussion is minimum alternate tax, MAT, which is popularly called. So there are, I mean, this section has been made so much of complicated that there are lots of judicial rulings on this particular section, because the way the section is worded, there is a lot of clarity required. required. Of course, the court has interpreted this section. As you know, this section is section 115 JB of the Income Tax Act, and those assessees, who are liable to tax under this section 115 JB is required to furnish auditor's report in form 29B. So at the end, you see, because as you know, what is MAT? MAT is basically to tax all those zero tax paying companies. Like, there used to happen that the assessees or companies, they had lot of accumulated losses. Also, the losses, unabsorbed business losses or unabsorbed depreciation, or the deductions under Chapter 6A, or was so much that those companies were not paying any taxes, or the exemptions available, under the provisions of the Act. So after claiming such deductions, exemptions, though such companies are earning a lot of income, there is a lot of income, and but they do not pay any tax, because they come under the zero tax tax paying companies in that bracket, because there is no income. So therefore, after set off or claiming exemption, the taxable income is nil. So they are not paying any taxes. So basically, to make such companies pay tax, this provision has been brought on the statute book. Started from section 115J, then JA, and now it is JB. So today, when you look at this section, it is section 115 JB, which we need to look at. As I mentioned, the objective behind this section is, this provision is to facilitate taxation of zero tax companies by making such companies liable to pay tax on their book profits. Okay, the section provides section 115 JB, as I mentioned, is a section relevant to this, and it provides the mechanism how to compute the book profit. You start with the profit drawn as per part 2 and part 3 of Schedule 6, and then there is an explanation to this section. There are certain adjustments that you need to make, okay, to the book profit. Book profit is start not, book profit is start as per the books drawn up as per the Companies Act, Schedule 2 and Schedule 3 of the Companies Act, and then part 2 and part 3 of Schedule 6 of the Companies Act, and then you make net profit as per the profit and loss account is a starting point, and then you make certain adjustment under the explanation 1 to this section, and then there are again certain deductions like brought forward losses as per the books, so on and so forth, and then you arrive at the book profit. Okay, liable to tax, on which the assessee is supposed to pay tax. So what you do is you compute tax, you compute your income as per under the normal provisions of the Act. Okay, so then accordingly you arrive at the tax liability, and then you compute tax under MAT provisions. Like as I mentioned, you start with the book profit, then you make certain adjustment, and there are certain deductions, and then on that that you compute the tax. So whatever is higher, higher of the tax computed under the normal provisions and under the MAT provision, it may so happen that not necessary that your tax is nil under the normal provision. It may be amount which may be lesser than the MAT tax. So whatever tax you are liable to pay under the MAT provisions would be higher. So whatever is higher would be your tax liability. So you compare both tax liability, you compute under the normal provisions, and then tax liability you compute under the MAT provisions. So whichever is the higher, as I mentioned, the applicable rate of tax is 15% plus surcharge and education cess, applicable surcharge and education cess. So you compare these two, and higher of the tax, is required to be paid by the assessee. Now, this MAT is applicable to corporate assessees, like companies only, and non-companies. There is a different. This MAT does not apply to them, but there is a provision. I mean, AMT 115JC is the one that we'll see at a later stage. So that is applicable to non-corporate assessees. 115JB is applicable to corporate assessee, and non-corporate, for non-corporate it is 115JC, that is alternate minimum tax, AMT. So we'll see as we move along. Now, as I mentioned, the MAT provisions are applicable to companies and not to individual HUF, partnership firm, etc., because those are not corporate assets. Now, there are certain features which are very important. Of course, we'll also see certain controversies as we move further. There is a provision called MAT credit. So, if during the year the assessee has paid tax as per MAT, because you compare with your normal provisions of the Act and you compare as per MAT, and the MAT tax liability is higher, then such assessee is required to pay tax under the MAT. Okay, then it so happens that if that such assessee is entitled to claim credit of excess of MAT tax paid over normal tax liability. So, excess of the tax liability under the normal provisions of the Act and the MAT tax paid. So, that is available for MAT credit, and as the law stands today, that such MAT credit, this is called MAT credit, and this is available to be carried forward to 15 years immediately succeeding the year in which such tax credit is computed. Okay, and after 15 years, it gets lapsed. So till 15 years, you can carry forward. Okay, and then every company is who is required and who is liable for MAT required to furnish the report in form number 29B. So I'll just flash this for the benefit of everyone. So this is form 29B, which is prescribed under Rule 40B of the Income Tax Rule 1962, and the auditor required to provide. So when you are issuing report under this section, the auditor's report is required. Again, the same controversy that this requires to be furnished along with the return of income, and the assessee, the auditor has to report that they have examined the accounts, records, and and then there is also it is required that you certify what is book profit that has been computed under the provisions of this section. Okay, so and then also auditor need to state that in his opinion the particulars are given are true and correct. And annexure to this report provides the particulars of the assessee, like name, address, PAN, financial year, total income of the company under the Income Tax Act, or total tax payable, so all these particulars are required to be certified by the auditor. So each and every provisions like under the section, like addition, deletions need to be provided. Okay, I mean every particulars need to be mentioned and certified by the auditor, and accordingly a report is required to be provided. The form, as I mentioned, the form is form 29B, which required to be certified by the auditor. So every item needs to be filled in whichever is applicable. most of the provisions may not be applicable to a particular assessee. So one has to be very careful, while certifying which are the clauses and what is the amount that such assessee is entitled to. And, what is the amount on which MAT tax is payable by such assessee. So this is the form that requires to be provided along with the return of income. Now, the very important issue that consideration, that is it that there was this actually whole of this controversy came because, see, at the beginning of the year, like, as you know, companies required to pay 4 installment, like June, so how do we know that in the quarter the assessee of particular company will fall under MAT? Because, as I mentioned, you need to compare whether the MAT tax is higher than the normal tax or not. So in the because books are not drawn up, it is all estimate. So the Karnataka High Court, in the case of Quality Biscuits, had taken the position that when assessee is liable under the MAT, it is very difficult to predict whether MAT is payable, or assessees will fall under the MAT provisions or under the normal provisions. So therefore, the High Court had taken the position that no advance tax is required to be paid by such assessee who fall, because it's very difficult to estimate, because the real picture of the assessee is drawn at the end of the year. So at the end of the year, assessee comes to know whether he is going to fall under the MAT or under the normal provisions of it. But that was not accepted, and the Volta India's case, Supreme Court has taken the position that even if the assessee falls under the MAT provision, still advance tax is required to be paid. So those are not exempted. So such companies are, even if MAT, assessees, corporate companies falling under the MAT provisions are also required to pay the advance tax. So they are not exempted. So it's a law of the land. Now it requires to be followed. And so, when one is issuing report under Form 29B, one has to see this aspect as well. Similarly, earlier SEZs, special economic zones, units, or where earlier there was an exemption provided. So when MAT was first introduced, it did not apply to income generated by companies via SEZ. Many units there, because that time government wanted to promote SEZs and all, because this was important for them, that SEZs were promoted and people take most benefits which are available under the SEZ. So, however, by the Finance Act 2011, the MAT provisions were also made applicable to all companies earning profits from SEZ operations. So this exemption was withdrawn later by the Finance Act 2011, because the companies were taking benefit of forming companies in SEZ, and thereby not paying any tax at all, because as you know that there is also exemption available under the normal provisions of the Act under Section 10AA 10, so they were claiming the exemption under that section and thereby escaping tax, totally tax-free companies. So those concession were withdrawn by the Finance Act 2011. Now all these companies as well required to pay MAT. As I mentioned, that MAT credit will be allowed to be carried forward for 15 assessment years, And then when the assessee comes under the normal provisions of that, they are allowed to set off this MAT credit. And when it comes under the particular tax provision, in fact, the advance tax, while paying the advance tax, this MAT credit is also entitled to be carried forward. I mean, set off. Assessee can set off the MAT credit available while paying the advance tax. Only thing is, in case of conversion of company, like corporate assessee who was paying taxes, under MAT, right? And it got converted into LLP. Okay, so it is provided that such MAT credit which company was entitled will not be carried forward and allowed in the hands of LLP. So that restriction is there, and again, this credit is not something like your deposit and you will claim any interest or anything. So no interest is available on such MAT credit. Now, as you know, that MAT has to be paid and applicable to only companies. Now, what happens to banking companies or insurance company to that extent? So there was a controversy, because whether such banking companies are required to pay taxes under the MAT. So what the Supreme Court, the matter traveled up to Supreme Court, and the Supreme Court has taken the position that because they are not governed by the Companies Act. Okay, so they are governed by the Banking Companies Act, Banking Regulation Act. Okay, so therefore, these provisions of Section 115JB is not applicable. Similar view has also been taken by the Supreme Court in the case of insurance companies, though they are companies, because they are not regulated by the Companies Act. So MAT does not apply to insurance companies as well. Similarly, what happens, like as I mentioned, when the MAT liability is computed, there are certain adjustments that you require to be made under the explanation 1. So where the provision for bad debts is made, because under the explanation 1, it is provided where it is unascertained liability. So that unascertained liability you have to add back to the book profits while computing. So if there is any amount which is shown, in the profit and loss account as provision for doubtful debts, and so whether such provision is required to be added back or not. So what has been held in the case of SEC Limited by Supreme Court, that provision for doubtful debts is not unascertained liability, but it is ascertained liability, because there is, it is not ad hoc, in the sense there is a scientific basis on which this provision is made, because we know the parties, or debtors, or for which this particular provision is made, and therefore it is ascertained liability. It is not ad hoc, or it is not unascertained liability. So therefore, provision for doubtful debts is not required to be added back in the while computing the MAT book profits for paying tax under the MAT. Now, so many times it happens, as you know, the books of accounts of the SSC are audited. Like, it is drawn as per Part 2 and Part 3 of Schedule 6, and it is audited. So is there any power to the assessing officer to make any adjustment? Because they say, because, so many times it so happens that the assessing officers are taking the position that certain deduction, certain amount is not added back. Therefore, the accounts are not drawn as per Part 2 and Part 3 of the Schedule 6, because section says that profit computed under the Companies Act as well Part 2 and Part 3 of Schedule 6, and then you make that adjustment. But if a particular adjustment is not made, then it is not drawn up according to that, and therefore they make the adjustment. So Supreme Court has taken the taken a view that where the accounts are drawn, auditors have certified that the accounts of the assessee or company are drawn up as per Part 2 and Part 3 of the Schedule 6, and due the report accordingly has been provided, auditor's report has been provided, then you cannot make adjustment on the ground that it is not drawn. What adjustment you can do is only provided under the explanation 1. You add back certain items and you reduce certain items. So therefore you cannot go beyond that. It's a standard items. It's a standard item which is provided under explanation 1, for which you can make the adjustment, and you cannot travel beyond those items, and you cannot suo moto take any position that you need to make the adjustment, because these are duly certified. The accounts are duly certified by the auditors. Okay, therefore these are drawn as per Part 2 and Part 3 of Schedule 6, and therefore you cannot make any adjustment. Here is another case of JK Synthetics, which is very important. Assessing officer here had taken the position that the depreciation was not computed as per the Companies Act. Okay, they had followed a different method. So what it says that profit shown in the profit and loss account was not the method of computing the depreciation or it was not in accordance with the Companies Act. So therefore assessing officer felt that the excess depreciation has been claimed, and it added made additions to the book profits, and accordingly assessee was made to pay higher MAT tax on those additions. The Supreme Court said that no, you cannot do that. Following the decision of Apollo Tyres, it held that once the accounts are drawn up, may be the method, but it was a method provided under Companies Act. So therefore, you cannot make any adjustment. You cannot tweak those accounts, and therefore, whatever the SEC has computed, that is correct, and you cannot make any adjustment. So these are some judicial controversies I thought I'll bring to your notice, because whenever you are issuing report under this section, you're doing the audit and issuing MAT report in Form 29B, then these are some of the points which we come across regularly. So whether you must take care, and you must see that these points are taken care of, and accordingly the auditor's report is signed. Similarly, as you know now, many companies are required to get Ind AS. Ind AS is applicable to such companies. So this impact of Ind AS has also been brought in Section 115JB. So certain additional adjustments are required to be made to all those companies to whom Ind AS is applicable. OCI, other comprehensive income, which requires to be added. Similarly, certain adjustments are required to be made. That will OCI items that will permanently be recorded in reserves. So then it requires to be adjusted. It is provided in the section itself what adjustment you need to make, and accordingly the book profit is recomputed. Under the under Section 115JB, taking impact of Ind AS adjustment. Okay, and these are some of the amounts, items which required to be included in the when you are computing and arriving at the profit of the companies which are impacted by Ind AS. Of course, this is a new concept. Ind AS is just come a couple of years back. There are no judicial pronouncements so far or there is no controversy as such, because as we move and audits or scrutiny assessment happen of all those Ind AS companies, we'll come to know the controversies. But these are certain adjustment on the screen which I have displayed, which are required to be made when you are computing the book profit of the companies which are liable for and whose accounts are drawn up as per the Ind AS provisions. Okay, so before we go on to the other provision, so is there any question on this particular section 115 JB, or we'll take the, as been mentioned, we'll take the question at the end? I'm happy with that as well. So we can discuss questions on any of these aspect as well. I'm fine with that. So I think we'll complete the other section as well, and then we'll have sufficient time for discussing questions, if any. Now, another aspect, when you are is the alternate minimum tax. So this is also another aspect, like alternate minimum tax AMT is applicable to all those non-corporate assessees. Corporate assessees MAT is applicable, and non-corporate assessees AMT or alternate minimum tax is applicable. So section dealing with this particular aspect is section 115 JC and 115 JC. Okay, and it applies to all non-corporate assessees, and again there is a comparison that happens. The tax is compared under the normal provisions of the Act, and then tax is compared under AMT, and whichever is higher, okay, is considered for the purpose of computing the tax liability under AMT. So there are provisions given. You pay AMT on the adjusted total income. So adjusted total income has been provided under the section, like certain deductions, etc. You don't have to consider chapter 6A deductions, etc. You don't have to consider, and on that you compute, and then you compare with the with your normal tax liability. And if your AMT tax liability is higher, then you pay the tax on the under AMT, alternate minimum tax mechanism. Only thing is, what is provided is International Financial Service Center, IFSCs. Right now, of course, Maharashtra is also going to have very soon. Right now, IFSC is in Gujarat. So so if any unit is located there, then the applicable and such unit is liable for AMT or alternate minimum tax, then the rate of tax is not 18.5% for them, but it is 9%. So there is a concession provided, except for cooperative society, where the AMT is provided is 15%. Of course, AMT is not applicable for all those taxpayers who are claiming 115 BAC or 115 BAD. So for them, it is not required. You don't have to do the comparison, and all those are required to pay tax as provided under 115 BAC and BAD. So as I mentioned, that these are AMT is applicable to all non-corporate assessees, and the audit report is also required to be provided, similar to MAT. There it was Form 29B. Here it is Form 29C. And deductions like Chapter 6A deductions, 35AD, profit link. Profit linked incentive like 10AA. So all those deductions, all those assessees who have claimed deduction under these sections required non-corporate, of course, and they need to compare their income along with the AMT, regular income along with the AMT, and accordingly the tax is required to be paid. Of course, there certain threshold is there. So all those individual HUF, AOP, etc., whose income is less than 20 lakhs. So 20 lakhs to them, AMT is not applicable. So 20 lakhs is a threshold, except LLPs, partnership, etc. So they are not entitled for this 20 lakhs threshold. So except for LLP partnership, all other non-corporate assets like individual, HUF, AOP, etc., are uh, not. I mean, they have this 20 lakhs rupees threshold for AMT. This is tabular form of how the income is to be computed. Like you have to add back chapter 6A, then 35 AD, so on and so forth, and then that becomes your adjusted total income, and then on that you also compute your normal tax liability, and whichever is higher is your suppose AMT is higher because of this adjusted total income as compared to your normal tax liability, then you need to pay tax as per the AMT. Um, similar to 115 JAA, here also under this one section 115 JC, there is a provision to carry forward AMT credit. There it was MAT credit, here it is AMT credit, and again here 15 fiscal years from the end of the financial year, you can carry forward, and thereafter it gets lapsed. Form 29C is required to be filed along with the return, in order to, and this is required to be certified by the auditor, and this is required to be furnished along with the return of income. And assessor need to certify that what is the profit on which this income has been computed, what is the adjusted income or profit on which this profit is computed, and accordingly the particulars are required to be furnished in annexure A. So whenever you are doing the audit of non-corporate assessees like individuals, HUF, so on and so forth, and where the AMT, alternate minimum tax, as provided under section 115 JC, is higher than the tax payable under the normal provisions of the Act, you need to furnish report in form 29C, and then need to be filed along with the return of income. That's all so far as 115 JB JC is concerned, as well as 115 JJAA is concerned. Okay, actually these are very small provision in that sense. There are not much of especially in the AMT, because this has been recently introduced, section 115 JB. There were certain controversies which I have brought to your attention. That these are certain judicial controversies. Similarly, the controversy regarding payment of advance tax. So one you may have questions whether a person who is ultimately liable to pay tax under AMT, whether he is required to pay advance tax or not. So yes, similar logic as was there under section 115 JB, like that AMT as well. For corporate it is 115 JB, for non-corporate is AMT. Similar logic is applicable to 115 JC as well. And all those SSC who are required to pay tax under AMT also required to pay advance tax. There is no exemption for them. And the similar provision is applicable, like when you ultimately ultimately liable to pay tax under the normal provisions of the Act, then you can set off the AMT credit, and to that extent, you don't have to pay tax under the normal provisions of the Act. So these are what I had to say about these three sections are concerned. When you are doing audit, so all these are critical points. You must take care and you must ensure that you are complying with, and accordingly, auditors report, as the case may be, 10DA, Form 29B, Form 29C is required to be given, but due care must be taken to certain points, which I highlighted, and certain controversies, which I briefly discussed, must be taken note of, when you are issuing a report and carrying out the audit under these three sections. There is a couple of questions. Is it mandatory to file 29B, that is a book profit is in zero or negative? Yes, it is required to file. Why I am saying this argument I had taken in one of the practical case, like it so happened that the SSC had originally return was filed under the normal provisions of the Act, but then it so happened assessment happened, and then ultimately the tax liability came to be zero. I mean, under the normal provisions, then the assessing officer took a position, then you pay the tax under the MAT. Then I told him, see, when the return was filed, okay, there was the SEC was liable under the normal provisions of that. So as the section stands today, and as it is provided under the provisions of the Act, that if you are liable, then only you file. If you are not liable, it's not required to be filed. But then assessing officer, no, because now after he made certain adjustment, then we made certain additional claims, because of which it so happened that ultimate tax liability came zero. But then he computed under the MAT, and MAT was payable. Then he said that you are not filed, MAT. Then I'll initiate the proceedings accordingly, because you are not filed. I said we have not, because we took the position we were not, at the time when we filed the return, we were not liable for MAT. There is no question of this thing. But then he said no. Then it may happen that because now the scrutiny has happened, and my file, your file will go to audit, and they will raise the objection. Then we, just to buy peace, we took the position that okay, we will submit now. Okay, and then he accepted. As a precautionary measure, it is better, always preferable, that you file, even if you are not falling under the MAT, you say zero, not liability, or your liability is lesser, then it is always better or preferable to file MAT report, even if you are not falling under the MAT. Do we report only income tax? Second question. In Part A, point 20, MAT tax, do we report only income tax or tax of surcharge? Now, this is a very good question. Now, see, how do we compare? Like, you have to compute the tax under the normal provisions of that and tax under MAT. So, under the normal provisions of the Act, when you are comparing tax, okay, it includes surcharge and cess. Okay, then it should not happen that when you are comparing MAT, your MAT tax liability does not contain surcharge and cess. Like has to be compared with like. If your normal computation of the provision at the Act contains, when you are comparing the taxes and the that tax with whom you are comparing, normal provisions that includes surcharge and cess, then you must include. You must compare, make the comparison accordingly, including surcharge and cess. Normally, under the normal provisions of that, surcharge and cess is included. So why not under the MAT? So it is you must add surcharge and cess. Then only the right comparison will happen. In case income is not taxable, exempt income under the Act. In case income is not taxable, exempt under the Act, but included in the net profit, how deduction is to be claimed under MAT? I did not follow this question. In case income is not taxable, exempt under Act, but included in the net profit. Now, how deduction is to be under the MAT. So here also, this is a very good question in the sense that I will go by what Supreme Court in the case of Apollo Tyres and the other judicial pronouncement has said. So what adjustment you can make, what addition and deduction is to be made is provided under explanation 1. Certain items are to be added, okay, certain deductions are to be made. It is provided under that section. If this exempt income is not there, under the reduction section provided in section 115 JB, then no adjustment can be made. It has to be taxed. You can't say that this is income is exempt. Of course, there are judicial pronouncement. I have come across section 54. Like use sell the shares, okay, and then that capital gain is exempt, which is credited. So whether to that extent exemption, to the extent of that exemption, whether you can claim the deduction. There are judicial, but there are contrary judicial pronouncement in the sense, exemption which you are claiming is under the provisions of the Act. Addition and deduction is to be done in the books of account, whatever is credited as per the books of account. So this, as per the exempt income, is as per the provisions of the Act. So which is nothing to do with what is reported in the accounts. So additions and deletions are required to be made as has been provided and as is there in the profit and loss account computed in the part 2 and part 3 of the sheet. There are judicial, I agree, under income tax if certain exemption is available, but then I will not subscribe to that because this is those judicial pronouncement are at the tribunal or lower level. As it goes to higher, at the High Court level, in my opinion, this is very difficult to withstand because additions or deletions are required to be made as per the books of account. What is debited and what is credited, and not as per what is exempt under the provisions of the Act. This is my view. A partnership firm will be claiming deduction under section 80 IBA and AMT will be applicable. Form 29C will be filed. But is tax audit mandatory if the other conditions are 44 AB not fulfilled? Even if you are under AMT, okay, Form 29C is required to be filed. But for if you have to comply, I mean, whether you are required to carry out the tax audit or not, you have to strictly go as per the provisions of Section 44 AB. If Section 44 AB provides exemption because of threshold 5 crore, 10 crore, or any other reason, then you don't have to get the accounts audited under 44 AB. But the report under Form 29C is required to be provided. Mind you, here what will happen, because when you are issuing a report under Form 29C, you are certified that you audited the books of account, you are verified and all that. So that you will state, but it is not the audit as may be required under 44 AB because section Form 3CD requires certain items to be reported. So in order to report those items, you need to carry out the thorough audit. But Form 29C is that also requires you to say you are audited, but only that audit to the extent of Form 29C and your satisfaction. Okay, that AMT is properly computed and not under 44. You don't have to give report under Form under Section 44 AB and provide certificate under that 3CD. That is not required to be given. Yeah, this question I just is it mandatory to file 20 when the book profit is 0 or negative? Yes, it is required. Practically, I have seen it is not mandatory. I agree, but then it so happened that during the case is selected for scrutiny, and there is, you come under MAT. In my practical case, I just shared with you that, assessing officers made certain additions, then we made certain claims, because of which, though there were additions, but then the taxable income under the normal provisions of that came to zero. But then, it went into the MAT. So to buy piece we find, but it's not mandatory, but it is advisable, in that case, that to avoid controversy at a later stage, because we know how these assessing officers, the department behaves. They can trouble you to any extent. So it is advisable, safer side, to, even if you are not falling in that MAT, it is advisable to provide, because you are in a way, why I subscribe to this view, because in a way you are making comparison, like this is your normal tax under the normal provisions of that, this is your tax under MAT. So in a way, when you are making the comparison, okay, then somewhere indirectly you are agreeing that this is your MAT tax liability. So it is always advisable in that sense also to provide the report. There is no harm. Of course, some assessees may not like, because there will be additional fees, but can't be helped, because you are making a comparison, and some assessee may be hesitant to carry out those, and take the form, because probably they will have to pay additional fees. But can't help, you have to convince those type of assessees. So I dealt with the questions that those were posted on the statute. Is turnover zero or no other income, net loss, whether this is similar to what I just said. Even if turnover is zero and no other income, net loss, there is no income at all, whether 29B. See, in this case, even if addition happen, what will be the addition? Because there will be loss, right? I think under normal provisions and under MAT also there will be loss, probably, because there will be hardly, because there is no turnover, there is no income at all, right? So in such a case, I think it may not be required. But then, you compute this thing, MAT liability, and you see under MAT also it is loss. Okay, under normal provisions, so of course it will be, because the facts show that there is no income. Normal provisions, it will be loss. Then under MAT also you see what is the, because starting point will be loss, and then you make adjustment as per the books of account. Okay, if there is still loss, okay, there is no this thing, MAT liability, then I don't think in such a case it is required. But as a precautionary measure, I think there is no harm in filing. At the most, just a small report in such a loss-making company, a small report. So I don't think so. Anybody should have a challenge, or assessee should raise objection. Of course, as I mentioned, certain assessees may raise objection, saying that it's additional cost. Already the company is making losses and you are making, but then you need to explain to them. As such, it is not required, but it is advisable to file. Any other question? Any clarifications?
I request members to ask the questions if they have any.
We have time. We can deal with them.
Sir, there are 3 to 4 questions in the chat box.
Yes, we have dealt with them. I answered all of them.
Yes.
Happy to take additional questions if there are any.
Hello.
Yes.
Hello. The incentive has been given during the COVID period to the automobile sector and all this productive incentive. Hello.
Yeah. Please. Can you repeat the question?
Given by the central government during the COVID period. During the COVID period,
Yeah.
government has given the productive incentive to the automobile and other industries.
Right. Product
So
linked incentive.
whether that incentive should be add back or adjusted while computing the MAT or tax liability.
See, as I mentioned, when you are computing MAT liability, okay, your starting point is first you have to see the profit uh, computed as per the part 2 and part 3 of schedule 6, as this has been provided in the section itself. Then you make certain adjustment and certain reduction. I think the way section 115 JB is worded, so these incentives maybe it all depends how it is disclosed. If they are credited to the profit and loss account, okay, because some people, what they have done is, I have seen this practically, but this needs to be seen as per the on the facts of your case. What they have done is they have not routed through the profit and loss account. They have adjusted against the fixed asset cost. Okay, so it is a balance sheet item rather than the profit and loss account. So it all depends how the accounts are drawn up. If your accounts are drawn up by specifically crediting this incentive to the profit and loss account, okay, so there is no provisions under section 115
Just like a
JB.
subsidy, all this.
Absolutely. There is no provision under section 115 JB to specifically.
It's a new item, so there is a certain problem.
Absolutely. So this is very difficult to claim as a deduction, because only this may be possible because certain assesses I have seen it is not, but this is subject to your auditor agrees. It all depends on auditor how he wants to, because he has to ultimately certify the accounts are drawn up as per part 2 and part 3 of schedule 6. So certain accounts are, these incentives are taken to the balance sheet rather than P&L. So where it goes directly to the balance sheet, there is no question of any making any adjustment, because there is no credit to P&L. So if it is credit to P&L, it is very difficult to remove that, because
Whether this is a third.
Yes.
So it is considered to the part of the balance sheet item, or 35 AD adjustments.
So
This incentive.
So if this incentive, see, for MAT, you have to go as per the books drawn up as per the Companies Act. Okay, so this incentive you need to see how it has been disclosed in the account. If it is credited to profit and loss account, there is no provision under under section 115 JB to exclude it. Okay, now certain assesses I've seen practically, they have convinced their auditors that this has been disclosed in the balance sheet rather than in the profit and loss. So in such a case, no adjustment is required, because it is not. But if it is credited, there is no mechanism to exclude under the existing provisions of the Act.
Because this is a new item and certain new adjustment need to be
Absolutely.
Before final.
Yeah.
Thank you, sir.
Any more question?
So I'll just tell you one practical experience. I don't know whether you have seen it. We had advised a particular assessee. They wanted to avail this incentive scheme. Okay, so what we told them is form a new company. You buy plant machinery, etc., and new plant and machinery, avail the scheme. You see the eligibility under the scheme, form a new company. Then it may be possible, like in that particular case, it was LLP. Okay, so they had started a business with new, and claim the exemption. Received the incentive. Then once you are there, then the MAT provision does not apply, because their new company and the deduction was claimed under those new 115 BAB, so where this tax audit is not applicable to them, so then it was possible, and they could come out of that, and they did not pay any tax under 115 JP or JC, because it was under 115 BAC. So that is possible. This planning opportunity is possible, could be considered. But otherwise, under the normal companies, where when they are receiving this incentive, it is very difficult to exclude them under the, unless you go under the new tax regime where MAT provisions are not applicable.
Yes. Any more question? Yes, Aditya sir.
Just to add here, there are a couple of decisions wherein they have held that since it is a capital receipt, such incentives, they are not to be taxed even under MAT.
See, I'll tell you, capital receipt, they are not to be, that's what I said. There are certain, even I just spoke of, I mentioned about this exemption under section 54. See, capital receipt, taxable, not taxable. Ultimately, you come under the Income Tax Act, okay? Because it is section 4, section 5, whether it is my total income or not, okay? So when you come to the provisions of the Act, so question or controversy really arises whether provisions or exemptions under the Income Tax Act could be applied to compute book profit. So, strictly speaking, section 115 JP, as you go, the adjustments are required to be made, okay, only to the extent what is provided in the section. So capital receipt or normal receipt, whether capital receipt is taxable or not, that's under the provisions of the Income Tax Act. It's a capital receipt not liable to tax. Agreed. But then there is no specific. There are judicial precedents. I mentioned. I made a mention of section 54. There are tribunal decisions, but those are, I would say, there is a lot of ambiguity and there is no clear, because those exemptions are under the provisions of the Income Tax Act and not under section 115 JB. 115 JB provides only certain adjustment, certain type of reductions which you can make. This is provided in the section. Okay, only those reductions you can make. There is no exemption for capital receipt under the provisions of section 115 JB as it stands today. So it is very difficult. No doubt tribunal would have taken this position, capital receipt not like that, but in the long run it is not going to, in the assessment stage it is likely to be assessing, revenue authorities may not accept this position that this is not liable. It is, you are inviting, in my opinion, inviting a controversy.
Yes. Anyone have any question? So I think there is no question. Now I am here for vote of thanks.
Okay.
It's proud privilege to give vote of thanks on behalf of Nashik branch. Thank you, sir, for taking time and giving us a guidance. It will definitely help our member in their practice. Once again, thank you, sir, for guiding us. I hereby declare that session is over now. Thank you.
Thank you very much. Thanks everyone for the patient hearing and raising the questions. I'm available again. In the hopefully my presentation will be circulated. So at the end of the presentation, my contact details are available. So anybody has any question, please feel free to reach out to me. I'm happy to address those questions. Thank you. Thank you very much.
Oh, thank you, sir.
Thank you.